Welcome to the chase. You know, we're all running this race. We're all trying to claim victory in it. In my job, I get to sit down with wealthy people all week long. I hear about their wins, I hear about their losses, and quite frankly, like a bartender, I hear about their heartache. And I don't want you to run that type of race, or at least I want you to succeed at the race that you're running, and I want you to succeed at something that matters. Think about it like this. All the while you're chasing after something that's good, God's chasing you with something great. Well, hello. Welcome to the chase. I'm Chris McAlpin, your host, and where are we in the markets? You know, when you look at the markets, when you look at the news, what are you seeing? Are you scared, or are you kind of licking your chops? Do you have cash built up, or are you just hanging on to your stocks and riding the roller coaster that feels like it's become? Or are you kind of managing somewhere in between? Do you have a definitive system in how you're going about things? So one of the things I want to do today is I want us to dive into the markets. We're going to just jump right in. And as I've studied markets my entire adult life, you look at them, you see numbers, you see charts, you start to see these big pictures, these moving patterns, and you wonder, what do you do with this? Surely there is a way to start to kind of disseminate what's going on. And how can we make decisions using math? Let me show you an example of what I mean by that. When you look at these charts, this is just a simple 5 days in the life of the S&P 500 back in May. Okay, you start seeing these ups and downs, and does this look like any type of rhyme or reason to you? Can you look at this and make decisions? Sometimes when you look at a really close picture, you might not be able to do that. So let's zoom out. Okay, let's look at the last 30 years in the S&P 500, and you start to see patterns emerging. You see this in the lost decade from about 1999 to the year 2012. Just any period of time. Does you see this up, you see this down, you see another up, you see another down. That was a sideways trend during this period of time. And then all of a sudden it just takes off and it goes off to the races, gets in another sideways trend for a period of time. 2015, 2016, it's off to the races up until 2018 through 2020. Jumps off to the races in 21. And it's starting to pull back, or is it going into a sideways trend? The thing I've always laughed about charts like this is I don't know what happens to the right side of the page. Okay, I can't predict the future. But as we start to see trends, we can use math to measure what's happening. So let's kind of zoom back in, look at that same picture of 5 days in the life of the S&P 500 back in May. Okay, now you see this trend with support here in the first couple of days of that particular week. The markets broke down, it broke beneath support, found another support level. The second and third, the third and the fourth day of the week, really in the fourth day, probably on a Thursday there, broke down beneath support, found another support level on the Friday. So you can start to measure what's happening, okay? And we call this trend following. And so this week, I have my good friend, Clint Sorensen, with me, the lead investment strategist for Sound Financial, the chief investment officer and founder at Wealth Shield, and my good dear friend that I like. Yeah, every time that clients are yelling at me about investments, I get to yell at Clint. He yells back. We have great conversations. Hi, Clint. How you doing, my buddy?
I'm doing great, Chris. Thanks for having me.
Don't you just love the markets these days? Are you having fun?
Yeah, I actually do. I love them. I love nurse period. I know it's painful for a lot of people, but this is how opportunities are born, and this is exciting. It's getting exciting and interesting.
And it's getting exciting and interesting, and totally being understanding to our clients and our listeners who have lost a little bit of money. We're not being a smart aleck about that at all. Clint, probably you probably share this with me. I think one of the most frustrating things in the last couple of years, if we went back and looked at that chart, 2015 and 16, the market should have lost more, shouldn't it?
Yeah.
2018, they should have lost more, shouldn't it?
Yeah, 20, right? I mean, when you see
Yeah.
these things, a lot of the, you're showing me, I couldn't help but think of Mandelbrot and fractal geometry within markets, because when you showed that chart, right, you're seeing these sideways trends and these breakouts, sideways trends and breakouts. You saw it really big before the global financial crisis, right? So it started in the late 90s, went through really 2008, where you saw that kind of sideways trend. And I think it broke out in like 2012 on your chart. What's really interesting about that period before 2008, that last decline, was you didn't have massive QE like we had. And so when you had any kind of market correction after the global financial crisis where the trend changed negative, the Fed has met that with printing money and or doing quantitative easing. It's not necessarily printing money, but doing quantitative easing. And as Jerome Powell said on 60 Minutes, printing money digitally. And so that obviously creates a lot of demand for assets, and you end up getting these quick reversals in trend. And so a lot of people got disenchanted with following trends because you had all these V-shaped recoveries, and so it was very much different before.
Yes. Well, and the V-shaped recovery, that we had a V-shaped economy, which none of us had ever heard about before the pandemic. But is it true that if the market's going to, if the Fed is going to manipulate the markets, and I told somebody this the other day, I'm going to use the word manipulation because it's exactly what they're doing, but they were not doing it for evil purposes. They were, in their opinion, doing this for the greater good. And there's many times, I believe, during the pandemic, it was for the greater good as well. But there were not some evil machination behind what they're doing. But when they're overly managing the markets and the economy, and they cut off the downside, don't they cut off the upside too? I mean, don't they kind of manage them and they squeeze them in to this tight little range?
Yeah, if you look at what they've done to the business cycle, which I think is going to be studied for years in terms of what were the effects, right? We can only know that in hindsight. So this is me being a bench warmer here and complaining about the quarterback on the field in terms of the Fed. But if you look,
agreed. Me too. I agree.
Yeah, if you look, they're just easy to pick on. But if you look at what's happened, right? So the global financial crisis, we thought the whole entire global financial system was going to vanish, right? And it was too much for people to bear. And so Bernanke came in along with the Treasury, started doing a lot of loan guarantees and then quantitative easing, interest rates down to zero, so real negative yields, and just progressed forward with as much stimulus as they needed to get the kind of wealth effect back moving. And one of the things that, they even changed a major accounting rule, which really helped, which almost marked the bottom, right, in terms of mark-to-market accounting.
Mark-to-market accounting. Mm-hmm.
Yeah. So a lot changed there to rescue or to stop, to really arrest the decline in asset values. And then the stimulus, it really just became about, they couldn't move beyond the toolkit of quantitative easing, because they couldn't get to the point of tightening without the business cycle changing. So when they were easing, the business cycle was in response to that accelerating, because you had demand for assets. They would buy, people would buy stocks with it or whatever, right? You had demand for lending. And as money started moving around, you had demand for goods and services, and profits went up and earnings went up, and people started buying stocks again. And then they got more wealthy, and you had this wealth effect, right? And that's a very condensed linear version of really what happens, but it's at least it's applicable here. And so you started getting this business cycle where you get these expansions, but they wouldn't last very long, because as soon as the Fed either started to taper quantitative easing, to even hint at tapering quantitative easing, or it wasn't globally in concert with other central banks, you had dislocations and events, and then you get another cyclical downturn, and then they have to come back with easing to get another cyclical upturn. So what used to take 7.6 years is now around 2 in terms of trough to trough business cycle as the way we measure it. And that's pretty nuts, right? And I think that's largely due to the fact that the Fed is just controlling it, because they can't get beyond the quantitative easing toolkit, because they can't lift rates fast enough.
Yeah.
And I think that's,
I'd say what we're going to do. I'm going to get us to trend following on stocks. Okay. But we're going to do an entire show on this topic here in a couple of times, because I just dove into Ray Dalio's book, The Changing World Order, and he talks about the business cycle. But what I found really interesting, and Dalio, he quoted the 50-year Jubilee in the Bible. I can't wait to start unpacking this. Kind of really seems like God knew that businesses are going to tend to cycle every 6 to 8 years. And so you had the short-term debt cycle of the Old Testament at 7 years. You had the long-term debt cycle at 50 years. And lo and behold, 3,000 years after that was written, it still fits. It's amazing how God knows these things. I think that's awesome. So we're going to have fun on this particular topic here in a couple months. And I promise to the listener, it's going to be understandable. So Clint and I got to get off of our nerddom box here.
That's right.
And we're going to, the main reason I ask you about the Fed and what's going on in the market manipulation, because it brings up this topic about trend following. Because when we look at markets, if I were to go back to that slide, listener, I want you to think about all the crazy squiggly lines that you see when you look at the stock market. And if you're watching the show, you're able to see what the slides I just showed, and we're going to show another slide in a minute, that it just makes you think there is an orderly movement, and we should be able to use math to give ourselves a good decision-making process. It's not going to predict the future. Math doesn't, it's not a crystal ball, but it should. This was my belief a number of years ago, Clint, that it should give us a great decision-making process. And so you give me the definition, because I had studied trend following, but I never, ever knew the name of it until I met you, honestly. You were the one who gave me the name. So what is trend following?
Yeah, so I got to credit Michael Covell wrote the book Trend Following, right, in terms of really putting that term into use, because as Jerry Parker, famous trend follower, would say, it's systematic, diversified trend following, which is
only your friends say those kinds of things, Clint. Yeah, what does that say to a guy who grew up in Lee County, Mississippi?
I was thinking, man, that's a little too advanced for me. But no, I think the basic definition of trend following is, and let's talk philosophically. Philosophically, it's saying, hey, I have no idea what, if I'm talking stocks, or what market I can buy. So it might not be just stocks. You can trend follow bonds and commodities and currencies and interest rates and all kind of crypto, everything, right? Anything that's somewhat liquid or has a futures market. And that's where trend following really was popularized, was in trend following, or was in futures markets. And really the turtles, where Jerry Parker was one of it. And Michael Covell also wrote a book about the turtles. Richard Dennis and William Eckhart, had an experiment about whether they could train traders or whether it was innate and, a natural phenomenon. And they put this program together and recruited a bunch of people and taught them how to trade futures. And
kind of like a movie you saw that came out about the same time. Trading.
Yeah, they said it's
the movie trading places. They did it in real life.
Yeah,
they actually did it in real life. Clint told that story so mundane. Jerry Parker, Clint's friend, was one of them, and they go hired a bunch of people off the street. Basically, it taught them like for a week or two. It wasn't like they went to Wharton or Harvard or Yale. It was just a couple weeks of training. Gave them $1 million in the early 1980s and said, "Go trade." And they ended up making a truckload of money. They made close to $200 million over the next 5 years. And now that I've said that out loud, I may have to go look at my sources and cite it. But you and I both read the articles in the books. I think we could cite it somewhere. But am I right? I mean, it's a huge amount of money they made trend following.
Yeah, right? I don't remember the exact amount, but yeah, I mean, trend follower. I mean, Richard Dennis himself had an incredible career. Bill Eckhart still has a fund that's doing incredible. And Jerry still runs a fund. And I think, Liz Cheval, she passed away, but she ran a very successful fund too. She was a turtle trader as well. And it's really incredible that this concentration, this philosophy concentration, had the consistent track record across all these different people. And it showed that the philosophy had merit, in my opinion. And so when you look at trend following, what the basic tenets are, is you're saying, I have no idea how to predict future price. I don't know what's going to go up and what's going to go down. So what I'm going to do is I'm going to measure, a very simple definition, what's up. It could be, higher highs and higher lows. If you look at a chart, right, and you just figure out some way to codify and quantify that, it could be like in the turtles case. I think they used a 40-day breakout. So if you broke to a 40-day high, you bought. And if you broke below a stop loss to make sure you protected risk. And if you went to a 20-day low, you exited the position. And then if you hit a 40-day low, you went short. So you could go both sides. And essentially what you're trying to do is you're just trying to figure out, is something going up or something going down? You want to be long those things that are going up, and you want to be out of or short betting on them going down if they're going down. And there's something beautiful and almost Zen-like in that mentality or in that philosophy, because you're just in harmony with the markets. And I think that's really cool.
Yes. And I'm going to talk about this at the end of the show too, but you look at the design of creation. God designed things to move in harmony. He designed them to be mathematically elegant, to be beautiful. There's sometimes where nature looks random. I thought of this, and you think of a tree, you think of a large oak tree, and it looks like the branches are growing randomly. But if you zoom out, you see the root ball under the earth, then you would recognize that there's symmetry to a tree. There is symmetry in nature, even in its beauty. And I love that. And we find the same thing in economics. We find the same thing in the markets. And so, and when you said that about a breakout, how do you define a trend? Because it's bandwagon jumping. I mean, we're just jumping on what's going up. Yeah. That's all we're doing. This is how traders can trade tickers and not care what the company is. Now, as a part of our biblically responsible investing, we don't do that, because we only want to own companies that don't harm people or don't earn revenue from harming people or harming the environment. So we do research into what companies we're buying. But at its purest form, it's what's going up, buy it, what's going down, sell it, right?
Yeah. So, I mean, that famous, I think it was Longboard Asset Management, did that paper about the percentage of stocks. They were just looking at the distribution of stocks. Yes. And they showed that like 1 in 5 lost, 75% or more. And like 1 in 5 had the big outsized gains. I was talking to Jerry Parker about that one day. And I said, he said that he had talked to those guys. And he said, well, if you had tried to attach trend following to it, like you had trend following as a discipline, does it change the distribution? And I'm quoting what he told me, but he just said, yeah, it absolutely does. Right. It changes the distribution, where it kind of cuts out those big losses. And I think that ultimately is the value of trend following, is that, hey, it's about, I talk about it in my new book a lot, which is called The Smooth Ride Portfolio. And in that book, I talk about trend following, and I talk about it in relation to the concept of surfing. Right. So if you think about surfing, you go out, I'm not a surfer, but you think about surfing, you swim out and you're on a board and you're waiting on a wave. You have no idea which wave is going to be the best wave. You might have an idea, like, oh man, that looks good, right? It's a big swell and I jump on it, but you have no idea which one you're going to be able to have your epic ride on. And so you just go out there and you swim and you take ride after ride, and you try to manage your risk the best you can. That's what trend following is. You spread your bets among a bunch of different securities, markets, right? You want to diversify as much as possible. And then you follow in my opinion, the same system on all those markets. It's robust. You buy breakouts or use moving averages, which is very simple, where I buy above a moving average and I sell below it. It's something very simple that you can implement across all markets, and you execute that. And the most important thing is managing that risk well. That means position sizing, how much do I bet on my position, and then knowing to always exit and stay disciplined to the system, because it's just about surviving long enough to catch that big wave. And those big outsized returns make up for all of the small losses, because trend following, and this is what it's commonly referred to as, is from a philosophical perspective, is cutting losses quick and letting your winners run. That is trend following. And Larry Hite, another famous trend follower, he wrote that in the book, The Rule. He said, look, the rule is very simple. It's cut your losses short or quick and let your winners run. And that's what trend following does. The best trend following systems, I think I saw this from Tom Basso. Highly recommend you guys follow Tom Basso, Michael Covell. There's several others, and then Jerry Parker.
Well, you got to throw Ed Sakota in there, because he's going to talk about managing your emotions.
Yeah, and then
rule number 3: manage your emotions.
And the whipsaw song, right? But yeah, yes. So I think what they show, and I think Tom Basso is the one that I gleaned this from, and he said that like the best like really great trend following systems are like 30 to 50% right. So it's really hard as an investor when you're competing against wanting to be right, that ego, like, oh man, I like to feel right, I'm smart, versus the wanting to make money and profit. And that's a very different game most of the time. So the investors that want to be right all the time, they're trying to have a 90% hit rate. Whereas a trend follower is just saying, hey, I'm going to buy what's going up, sell what's going down, have a Zen-like approach. I'm going to codify everything and remove execution from me so I don't get in between it and challenge the system itself and lose discipline. And I'm just going to follow it. And if you do that consistently, at least historically, the track records have proven that it's been really successful. And I think that's the merits of trend following. It's hard to do. And I think I've heard people say I could publish rules and no one would ever follow them. Right? I think it's really hard to follow it because it isn't right. It's wrong more than it's right in a great trend following system. Mm-hmm. But I do believe that it is one. If you look historically, at least, it has been the most optimal system from a risk perspective to invest with. And I think that's why Jerry Parker calls it trend following plus nothing, right? Forever, right? Yep. That's his mentality. Yep. And it's hard when you're managing in clients, Chris. It really is.
We've talked about this a lot. You and I have, because here we started off talking about the Fed. As they manipulated the economy and the markets, it made trend following very hard because the V-shaped markets, you got false alarms. Yep. Let's go back. I mean, if we think about this in 2018, right here, what we have on the screen is 10 years in life of the S&P. We'll go back to this screen, and the line that's trailing is the 10-month moving average, where if you sold right there at the 10-month moving average, yes, you avoided this loss, but when you got right back in, you didn't better yourself.
Yep.
I mean, there is a frustrating side to the investment. So why do you stay with it? Why do you believe it's right, and why do you stay with it?
Yeah, it's because you zoom out, and when you look at it, you have positive expectation. You should, in any trend following system, have what's called positive expectation, which means I run a lot of tests and I look at this system, and my gains are 3 times the size of my losses historically. And probabilistically, I expect that to manifest if I run the system long enough. It's like being the casino. You know, I was watching the movie Casino the other day. Not exactly the most wholesome movie, but very interesting thing that they said there. They said
you watched the you watched the TV made for TV version.
I did.
Yes.
And it's funny because they were talking about it's based on a true story, but one of the things that
it is.
Robert De Niro's character in that movie said was the goal was just to keep them playing long enough, right? Just to keep them coming back, because if they played long enough, the casino won. I believe that in trend following. I believe that if your expectation, if the system's designed appropriately, if your expectation is that you have positive expectation, meaning if you take a number of trades, you should have a positive rate of return on that, relative to the risk you're taking, then I believe that you've got a good system, especially if you manage risk well. And managing risk, we could spend a whole podcast on that, Chris. Or a whole episode. Managing risk is the most important thing, meaning how much do I bet on each position? How many markets am I trading, right? Where's my stop loss? Where's my exit? Running tests on those things. That's far more important than when I buy or sell.
You keep using the word betting and comparing it to casino. I've told our clients for years and years now, this is not gambling.
Are you sure?
You're using these gambling analogies.
I'm sorry. Yeah,
I'm gonna have to rewind everything I've said over the last decade and a half.
I don't even gamble, so I don't know why I'm saying that.
It's because I get what you're saying. I completely do, and I think our listeners know I'm joking. But in the casino, you have to let's go use the same movie, the old movie Rounders. Matt Damon character. He looks at his wife and he says, "I'm not gambling. I'm not betting on luck. I know when I'm going to win, and I know when I'm going to lose." And we're doing the same thing in investing. I've said this time and time again. You spent some time today writing, and I did too, that hope is not a strategy, and you've got to have an investing system. If you want something that's more passive and it's buy and hold and it's long term, and you're not trading in and out, fine. but you've got to have an investing system. We're talking about one investing system today. You know, our friend Alex Pasden said to me years ago, said, Chris, I can build you 100 models at work. Which one can you keep your clients in?
Which can you handle, right?
Which ones can you handle? And so that's what we've talking about here lately, fitting the risk. And, you know, something that an investment that fits your eyes. You know, quite frank, personally, I've held positions that do short to market before, but I don't really care for it. It doesn't fit my eyes. I don't like it a lot. So I don't tend to do that a lot because it just bothers me emotionally, as opposed to running a trend following system in stocks. And all of a sudden I'm sitting 50% cash, 50% stocks, and the markets take off. Well, okay. Well, we'll just rotate back in and we'll catch up. It'll be okay. I'm not worried about that.
Right. And you know, in this period you're showing on the chart is so applicable, right? If you bought and held, you outperform trend following here, right?
Yes, absolutely. Yeah.
Right. Look at all but that's where people start to get disenchanted with trend following, which
right. I mean, like right there, false alarm, and you missed that double dip. Here's another one. Missed it, double dip. Hey, we felt really smart over during the pandemic, right? And it didn't better you at all getting out and getting back in. Sure felt smart here for these few months though. You were not.
And then hindsight bias creeps in, and people are like, "Why didn't you buy that low?"
Yeah,
you know, the low I see
because when the chart on this day right here, the end of the chart looked like this over here.
Exactly.
You know, we didn't know what went right.
Exactly. You never know. And I think that's the great thing also about trend following is you have a system. You don't have to. You don't have to predict. You don't have to have a crystal ball. And as Ray Dalio says, those who live by a crystal ball eat shattered glass. So I don't want to eat shattered glass. But if you look at this period, it outperformed trend following. Yeah. But still, if you look over the long term, and I'm going to pull this up real quick, Chris, but we ran a test from 1881 to 2021. And Med Faber published a paper called Quantitative Tactical Asset Allocation, QTAA, very famous paper he published, where he used the 10-month moving average over the S&P to go to cash. And he showed the efficacy of just applying that simple rule you just showed on the S&P 500 and how it would have manifested in like returns from a stock perspective, meaning you would have returned slightly better than the S&P, but with half the risk. Well, we did a little more comprehensive study in terms we run it, right? We ran the same 10-month moving average, but what we did is when we're out of the market, we're in bonds. We just said, hey, we're going to go to treasuries. Since 1881, using the Shiller data set, our test showed that your annual.
So I want to explain this before you share that screen. I want to explain what everyone was just saying. So let's look back at this test for just a minute so that everyone on screen can see what we're doing here. You've got the last 10 years, 10-month moving average, S&P 500. And when it broke below, assume that if it broke below the 10-month moving average, you sold.
Yep,
and you went risk off. Okay. Yep. So here, false alarm. Here, false alarm, but those 6 months you felt good about it. Here, false alarm. That quarter, 2018, you felt good about it. Here, false alarm, but only because the Fed stepped in, put $5 trillion into the economies in the markets, because that was the pandemic. So but you're able to invest in stocks and manage risk, which we've talked a lot about avoiding large losses. This is one great way to avoid, in our opinion, a great way to avoid large losses, that when those stocks fall beneath the 10-month moving average, you sold and went to cash. Now, Clint, you're talking about going back to 1800s.
Yeah.
1800. Okay. And you should be able to share your screen. And
I don't.
Instead of selling it, going to cash.
Yeah, I don't have it on my screen. I'm just going to rattle it off. But,
okay, go ahead.
But yeah, so we tested it back to 1881, and what we did is we just took the Shiller data set, which had the S&P data that he kind of was able to cobble together back to that long to do his cyclically adjusted price to earnings ratio. And we took that data and we said, all right, let's test 10-month moving average. If it's above it, we're in the S&P. If it's below it, we're in Treasury bonds. We use the 10-year Treasury, and we're going to do that every single month. That's all we're going to do. Look at the market every single month, S&P. If it's above the 10-month, we're in it. If it's below it, we're out of it. Exact same rule set that Meb Faber did. We just went back a little farther. I think his was from 1900 or something. We had the annual return if you did that strategy. Obviously, we have hindsight, the benefit of hindsight. This is just a test. But you would have compounded just doing that simple rule at 9.39% after dividends and inflation. The market would have compounded at 7. So that's a big gap over that period of time.
Big gap for 130 years, 132 years. Yeah.
Now here's the kicker, and this goes back to what we were talking about earlier. The maximum drawdown on the S&P on a monthly basis was 76.8%. 76.8% drawdown. The max drawdown on the system would have been 35%.
Okay. Yeah.
The max drawdown of a 60-40, so kind of a blend of the two, would have been 50.4%. And the 60-40 would have only compounded at 5.53%. So we want to show like what a blend of the two would be.
Yeah.
So the demonstration just said, hey, and this was just stocks. It just said, hey, applying trend following does a great job at really helping manage risk.
And when you say 60-40, by the way, because we just did a show on this, you're not talking about the traditional 60% stocks, 40% bonds. You're talking 60% trend following, 40% traditional.
Oh no, I'm talking traditional. I did 60% S&P, 40% in treasuries to show.
Oh, really? Oh, wow. Okay. Okay. All right. So the traditional actually, okay. So you mean bonds have bad days too, right?
Yeah, bonds have bad days. And so I'm a big believer that you trend follow almost everything. It's just very difficult from a client perspective. And let's go back to this 10-year period, because I think this is the key education point. Everyone looks at things through that recency bias, through hindsight bias. They think this time's different and things have changed. And so when you go through a 10-year period like this, we're following a trend following system, you would have underperformed pretty drastically just buying and holding. People immediately start to think it doesn't work. Yep. And since the global financial crisis, looking at systematic diversified trend followers, which any of you can pull up by looking at managed futures track records, they all underperform the S&P. It's not like they lost money over that period. They just didn't make as much as the S&P. So people got disenchanted and were like, I can't mess with that anymore. I'm getting out of trend following. And you had massive capital outflows out of the position. And I actually think that's the reason trend following will always work and always be robust, is because the way money flows, people are always going to try to go to the highest Sharpe ratio. Define that real quick. It's just a measure of your return over some risk-free rate divided by volatility. That's all you're trying to look. You're trying to look at a volatility adjusted measure of risk adjusted returns. That's all you're looking at, right? So you're trying to compare strategies. And a lot of people say, oh, I want to buy the highest Sharpe ratio strategy. And that's a common thing investment folks look for, investment professionals. That's not the best thing. In my opinion, I actually argue against that. I think what you want is you want the most robust strategy. And it's hard to argue against trend following being that, because of its ability to cut off that, what I call that left tail of the distribution. And obviously, if you diversify, it's even better. And you trade a bunch of different markets. In my opinion, it's hard to really beat that as an approach to invest, especially investing what I would call liquid vehicles. So anything in the futures markets, public stocks, bonds, I think ETFs, I think there's a tremendous amount of an advantage to trend following those things. And again, to your point, Chris, I don't think you have to go long short, although there's a lot of advantage to being able to go short and capture those opportunity sets. Yeah. But that's not what you have. Trend following can be just what we just described, stocks and bonds, right? I go from stocks to bonds, very simple, or stocks to cash. And I think that has carries a lot of merit. And something that Paul Tudor Jones said recently on CNBC is he said what he thinks will work over the next 5 to 10 years is trend following. And the reason why, he said simple trend following. And the reason why is kind of been out of favor and you're moving to a different regime. And, it makes a lot of sense. I don't know if he's going to be right. Again, don't have a clue, but I know trend following gives me that fighting shot of capitalizing on it.
Well, it's you and I've said a lot of times, we don't have a crystal ball, and it's an admission of not knowing the future. It is, I'm just investing in what's going up and I'm getting out of the way of what's going down. And as one of the guys on your team that likes to say a lot, I think it's Carter likes to say, I don't like trying to catch a falling knife. I'll just get out of the way, and I've stolen that. So I've said that a lot. I don't like trying to catch a falling knife. We're just going to get out of the way, So, man, I appreciate you being on the show. I think that as we're talking about this today, in looking at that picture, we can see, and our listeners can see as well, there's going to be false alarms. There's no foolproof system. If there is a foolproof system out there, they are quietly running it well and making a truckload of money. But exactly. I tell you what, of all the people I've read and studied, you're not going to find it. I mean, Ray Dalio just has put out a 3-book series who built the largest hedge fund in the world. And he's the one who said, those who live by a crystal ball end up eating crushed glass. I mean, there's not a foolproof system. You're going to go through the ups and downs. We just want to avoid large losses. We want to let the winners run. We want to manage our emotions. I've said this a lot, test everything. Doesn't guarantee the future, but we can at least look at the past and test it and say, if this plan performs something like it has in history, if this investment process does, I can fit it in my financial plan and having a reasonable shot at being successful financially, right? And then the last ladder is always the last one. I say fit the risk. I want it to fit your eyes. I want it to fit your investment eyes. So Clint, my friend, thank you for sticking around with us. All right, buddy?
Hey, it's a pleasure. Thank you.
Come back soon. We're going to do the next couple of series together. We're going to talk about recessions and economics in the next series. We're going to get into the business cycle, the debt cycle, that 7-year, that 50-year, why it got shortened, why it won't stay short, in my opinion, because only crunching it down like that, it means it's manipulated. So we're going to get to dive into a lot of these topics this summer because I want to educate our listeners. This is something we say this a lot, that we're blessed in this nation. You have a lot of wealth. You need to manage it well. God has blessed you. And so, Clint, thank you for helping us with this. All right, buddy?
Thanks, Chris, and thanks for the chase.
Absolutely. Man, I'm glad Clint stuck around with us and had that conversation. I hope that you, as you're listening, that you're able to see at least how one active management system can work. It's one that we like a lot here at Sound. And the quick story behind it, just almost 10 years ago when Danny Matthews, one of our original founders, had done such a good job of managing investments for years and years. Joel Holden, Jim Towns, and I started looking at different systems as we started leading that process for our clients here at Sound. And the old do a ton of research, look at a ton of data, use your gut instincts. That just didn't fit my giftedness. And Joel didn't feel like it fit his, and Jim didn't feel like it fit his, but math made a lot of sense to us. And so we wanted to look at markets, measure what's going on, get into an uptrend in an investment, and just simply get out of the way of risk as it's coming down. And so this is a system that has been proven to do an excellent job for many years. And so I hope that you've learned something with it. But, everything on earth originated from an intelligent designer. Even the markets, they're designed by people who are made in God's image. And so the markets have echoes of God's intelligent design in them. They move up and down based on math. They move up and down based on inputs from the outside. And when you're taking liquidity out of the markets, as the Federal Reserve is doing right now, there is going to be the effect that certain parts of those markets go down. It's going to affect stocks in certain ways. It's going to affect bonds in certain ways. And while it's not exactly, it's not predictive in the exact degree, okay, it sure does forecast it very well. The Bible says that God is not a God of disorder. We can see this in 1 Corinthians 14 and Ecclesiastes 3, that God is not a God of disorder, but for everything there is a season, and that everything should be done orderly, and that God made everything beautiful in its time. And I love that idea when you can look at the world and say there is the echoes, because listen, we know that the world's broken. We know that it's a wreck. We know that it's a dumpster fire sometimes, but we can still see the orderliness of God's design. And if we take and we recognize God's resources and opportunities that He's blessed us with, and we match that up with an orderly design, we now have a higher degree of, or higher probability of success. All the while, we're not trusting our money, we're trusting God. But just look at it, our own foolishness and the craziness of others, that's what creates chaos in our lives. But God created the world to grow, to rest, to kind of ebb and flow in a perfectly designed pattern. We see that got broken when sin entered the world, but you look at the seasons. We have spring and it's growing. We have summer and it grows into hyper growth, right? It gets overheated. Fall, we start to see in the dying and the cooling off of the environment around us. And then winter, everything's dead. And then the spring, it comes back to life again. It grows through summer, fall, and dies in the winter again. So everything in God's design is good. And so we look at financial designs because we trust God has placed them in there. Ultimately, we were not going to find perfection until Jesus Christ comes back. But we see God's designs in the economy and in the markets, and we want to move with those ebb and flows. So trend following, it's a great way to do that. It's a great way to tap into the market's designs. It's not perfect in any way, but I think it's an excellent way for us, an excellent tool for us to use. So while we see the echoes of God's designs in the markets, and while you're chasing success, you're chasing good creative ideas, I want you to go be excellent at what you're working hard at. But know this, all while you're chasing something good, God's chasing you with something great. Take care. God bless.
For disclosure and citation information, please go to www.soundfsg.com/disclosures.